Alrighty, let's get straight into it. This is Xavier with your weekly financial update just on the markets, on the dollar, on yields, on gold, silver, everything that's over here, oil. We're going to be looking at Bitcoin, a little bit about how our fiscal balance sheets are going, how the government's spending their money, see if any of that's increasing or decreasing, and let's go straight into it. So for the dollar, this is a monthly chart. Let's get off of the monthly chart. This is a weekly update. For the week, it's actually up. I did already look at this chart. But for the week, the dollar's up just a little bit. It does seem like it's fulfilling some sort of like flag pattern where it's going up, it's consolidating, and then it may go up just for one last run. Keep in mind, okay, keep in mind, I say one last run because every other commodity bull market, the 70s and the early 2000s, they all had lower dollar. Okay, so the commodities are all priced in dollars. Whenever the dollar goes down, the price of the assets would go up, all else being equal. Okay, oh my gosh, why is this not moving? So yes, if the dollar goes down and the price of the asset stays relatively like the same with the supply and demand of the commodity, the price of the asset's going to go up because these assets are priced in dollars. Dollar up slightly, just a little bit this week. Uh, Dollar and yields are positively correlated. So if dollar goes up, I would expect yields to go up as well. Uh, but actually, it looks like for the another one for the month. These are all in the month, okay. But for the week, it looks like yields were actually up by 2%. So yields were looking pretty strong for the week. It's still making this little flag pattern where it goes up since 2020. Guys, take a look at this. Remember, we were in a 40-year declining yield environment, okay? This is a 40-year bull market in bonds. It broke out. Now we're consolidating sideways. This is a bullish wedge, okay? Goes up, it's going sideways. I think it's going to break down, okay? I think it's going to break down with a false breakout, and then it's going to slingshot to the upside, okay? So, yields slightly going up would mean bonds probably slightly going up as well. So, let's go take a look at. Guys, I'm not paying for trading view, okay? Let's go take a look at bonds, all right? And bonds for the week are actually down, okay? This still looks at least modestly okay for bonds on the short term. It looks like there's some sort of like bull. There's some sort of like support underneath here where it can go up a little more. On the bigger picture, bonds look disgusting though. And remember that 40-year declining interest rate environment. So this right here is directly influenced by this right here. So this big increase from 2003 all the way until 2020, that is directly correlated to the yields going down. So if yields end up breaking to the downside, like I think they will, uh, it's going to be like a shoulder, head, and shoulders. Shoulder, head. It's going to be a shoulder. This shoulder is going to be in the form of a false breakout. This shoulder was just uh, in it was just the middle of the last bull market for bonds. But this is a false breakout. So as it's false, it's going to go right back down, meaning yields are going to go up. So bonds look okay. They don't look actually bonds look pretty bad. If I'm being quite honest, guys, just disregard this chart. Okay, this is just too much of a short term chart to even give it too much acknowledgement. You look at the bigger picture, like you don't break out of these 40-year patterns for no reason. You know, you broke out of it. You're doing you're moving sideways. Investor psychology still doesn't know which way the market's going to go with bonds. Should I hold my 60-40, 40% bonds, 60% stocks? Should I do maybe 40-60 with like gold and energy stocks? Should I do 60-40 with crypto and bonds? See, investors don't know what to do with their money right now. There's a lot of fear in the market, a lot of confusion, and yeah, and you can kind of see that with the way yields are trading on the longer term picture, and as well as bonds. And then looking at housing starts are still moving sideways. So just I always put housing starts here to give you like a reference where we are in the business cycle. Housing starts are contracting, but they're moving sideways. This is a little bit recessionary, not too bullish, as during commodity bull markets, we do want to see an increase in housing starts because that's what actually puts money into the system. Fiscal money also puts money into the system, but the housing cycle and the business cycle is more directly intertwined with the technicalities of money creation because money is created by loan issuance. So whenever they put a new mortgage onto a new house, that's new money coming into existence. When we see contractions of said money coming into existence, there can be some problems in the markets. And I always refer to just look at what happened in 2007, 2008. Absolute housing destruction to the downside. We're not seeing any of that right now. So we're not seeing any 2008 type scenarios where we were actually oversupplied in this area. Right now, we have no inventory. So this was a housing bubble. Right now, we're in a massive housing shortage. So we're in two completely different ball games. Uh, if yields do that false breakout where yields, let's go back on the yields chart, where yields do break to the downside, we should see housing start to rip. Okay, because the reason that housing starts are going to rip whenever yields go down is because housing affordability is going to increase. More people are going to be able to buy houses. Millennials will be able to buy houses. So when yields go down, millennials buy more houses. That increases loan issuance through the real estate market, which creates inflation. And that inflation is as inflation goes up, that interest rates chase inflation, and then yields begin to go back up. Okay, at least that's what I think, and that's how I'm seeing the market. Gold, gold for the week is pretty down, but it looks all right, guys. Oh my gosh, this will move. Gold looks fine. It's been up like 40% for the year. It needs a break. It's probably going to consolidate sideways. I drew this little pattern here. It's probably going to, I don't know when it's going to break out, but gold looks fine. Uh, it's been doing really, really well for the past year. I'm going to reset this chart. Like for the last year, it's just like big move to the upside, consolidation, another big move to the upside right here. It's going to consolidate, and then we're going to see another big move in gold. Just buy gold. Just be patient, buy gold. Silver is pretty much doing the same exact thing for the year. Big up moves, some consolidations, and then breakouts. Right now, it might be making like a little wedge pattern. Uh, I'm not even gonna draw it in. On the bigger picture, though, on the really bigger picture, oh my gosh. Yeah, for the really bigger picture, silver looks absolutely amazing. Like, I feel like we're somewhere in the early 70s when it comes to at least valuations. Because look at silver right now. Okay, silver's breaking all-time highs in dollars. Let's do silver to the M2 money supply. Guys, look at this. Silver's dirt cheap relative to all the money that we've been printing, but relative to dollars, it's breaking all-time highs. This is already in logarithmic. I take this off a logarithmic, the chart starts. Oh my goodness. Oh my gosh. Regular logarithm. Oh my goodness. It doesn't even change whenever it's on regular logarithmic. Well, that's because there's just trillions of dollars into the money system. Uh, but silver is looking really cheap relative to the M2 money supply. 1 year, a 5 year analysis of it. Pretty much ever since 2020, it's been pretty good. The 70s is just really ripped. Right now, we're at the same valuation we were in 1972. So, to give you a little bit of context, platinum. Platinum's looking pretty good. Even though it's down for the week, even though it's a bullish engulfing, platinum valuations are looking extra spectacular because we just sliced through a 15-year long pattern. I'm expecting some sort of retest before we like start to moonshot higher. You look at platinum valuations to something like the S&P 500, platinum to S&P 500. breaking out of 15-year patterns at the same valuations we were in 1999. Okay, to put it in better point of view, this was the beginning of the last bull market, 2000 to 2008. Big technology bull market over here. Right now, we're in like the AI bubble phase of the bull market in the beginning of the last bull market, and this is going to go a lot higher. It's going to go a lot higher. In the 1970s, the platinum to S&P 500 ratio was a 9. That means for whatever the S&P 500 was, multiply that by 9, and that was around the given price of platinum. So the S&P 500 wasn't 1,000 in 1980, but let's say it was 1,000. That would mean like that would mean $9,000 an ounce of platinum, because the S&P 500 was $1,000 and the ratio was 9. So it would take 9 shares of the S&P 500 to get you 1 ounce of platinum. Pretty interesting. But yeah, I think platinum's gonna rip. Oil, oil's looking pretty decent. It's just consolidating. I do think we're gonna have a flush in the market, so oil's gonna go lower. So on the short term, I'm really bearish oil, but oil looks pretty bad. Looks like it's gonna break down before doing some type of like at least what I call a slingshot pattern. Oil valuations are just they're just so cheap. Okay, oil to the S&P 500, it's at ludicrously low valuations. Guys, look at this chart by the way. Look at this chart. This chart goes back from to 1881. You see, we have big long-term phases of oil outperforming the S&P 500 and vice versa. Okay, you see this ratio gets super high, gets super low, it gets super high, gets super low. Right now, we're at the lowest valuations we have ever been. Okay, oil priced in the S&P 500, oil priced in technology stocks going back to 1881 are at all-time low valuations. Guys, this is going to get really bad, okay? This is going to get really bad because what this causes is underinvestment in oil at the same time that well declines are happening, okay? So you dig up some oil out of the ground, the total production is going to decrease. The rate of that production, the rate of the wells is going to decrease at around 10%, give or take, around 10 to 15% per year. Okay, when you keep getting these stupid low valuations, when low, when the valuations are persistently low like they are right now, what you're gonna cause is underinvestment into the oil market, which ends up creating a supply shortage because well declines, meaning uh, the oil that's in the ground, the amount of oil that you can get out of the ground is it goes down every year, year over year. So the amount of oil that you're able to produce decreases while investment decreases, and that's going to create a shortage. Okay, so we're already in a shortage of housing, which is pretty bullish on the inflation side. If we keep getting stupid cheap valuations like we are right now, we're going to get an undersupply or a shortage in oil as well. We're going to see our inventories get absolutely destroyed, and this ratio is going to slingshot. It's going to absolutely slingshot to the upside. Something look is going to look something akin to the 1970s. Okay, imagine the 1970s, but globally. Okay, and then yep, this is the oil to gold ratio. Hasn't been this low since COVID. Just buy these cheap oil companies. These oil companies are achieving free cash flow with all-time low valuations. Just think about that. A lot of these technology companies, I mean, they take like 8 to 6 years from their IPO to become profitable. These oil companies are profitable off all-time low valuations. Okay, like tell me where the value is. Tell me where the value is in the market. The S&P 500, it was gapping higher. If you go into the 6 month chart, yeah, you see these little gaps where there's just like those space. That means the market just opened at a higher price. It's very bullish typically, but when you're at like valuations like we are right now, you kind of have to start calling bubble territory. So you saw the S&P 500, you saw gold. The S&P 500 to gold ratio is declining. Okay, actually for the month it was actually kind of solid. It was 0.83. but it is in a reversal. So what we are going to start to see is that the S&P 500 may start to it may continue to go up, okay? The S&P 500 may continue to go up, but gold just goes up that much faster, all right? Gold's going to go up that much faster. The ratio is going to go lower because gold is going to outperform the S&P 500, and that is going to be the signal that we are in an inflationary environment, okay? Akin 1970s, early 2000s, and in the 1940s as well, but like on a smaller scale. Even though it was a world war during the 1940s, so it kind of got a little distorted. But we're already at the same valuations we were from around 2008, 1973. A lot. The S&P 500 to gold right now is more expensive than it was during the Great Depression. Okay. The tech bubble was a really good technology bubble, especially relative to gold. Absolutely moonshot it to the upside. We're gonna look at SOX, the semiconductor ETF. It's just an extension of the S&P 500. Most of the S&P 500 are these large semiconductor companies. So, no surprise that SOX is also going up. So, I mean, the momentum's there. The valuations are just looking really expensive for technology companies. Bitcoin, Bitcoin is actually consolidating. It looks like these big red candlesticks don't get me too excited. Kind of makes me think he wants to like go sideways a little bit longer. It does have some resistance around 80K and a lot of resistance right above like 100,000. So it could like trot at 100,000 for a little bit before you see volume either take it to the upside or to the downside. We will see. But Bitcoin, just doing Bitcoin things, super volatile, and it can go higher. This can be like a little flag pattern where it breaks out to the upside. It can go higher, but I'm actually not into much Bitcoin at all. So, if I'm being quite honest, but it does look pretty good. Ethereum, it is sitting on top of like really large patterns too. It looks decent as well. And the Baltic Dry Index, I am pretty heavy in the Baltic Dry Index, and for the last month, it's been doing pretty good. It's been doing pretty good. I got in around here, around like 1,300 into some of the companies, which is pretty low. But just a reminder of what the Baltic Dry Index is. The Baltic Dry Index is essentially just marine transportation, okay? Marine transportation sending coal, liquefied natural gas, oil, sending it from like China to the Americas, or sending it from Europe to Africa, or sending it from South America to Europe. Marine transportation of commodities, that's what composes of the Baltic Dry Index. And it's super cheap. I am in it. It's making a pretty nice pattern that I really like, and the valuations are really low, really low. A really good company from the Baltic Dry Index I like to look at is SBLK. I know, right? Look at this pattern. This is because they diluted their shares into infinity, as well as remember from 2008 to pretty much now was the technology bull market. But yeah, SBLK, it's putting in a pretty good base. It put in a pretty good base, and then whenever the market condition did start to get favorable, it started to break out, and now it's forming a new pattern to the upside. I really like this. I really like this. It's a double bottom. It's a breakout, and then the flag pattern. This is gonna break out to the upside. It looks really good. For the week, is this a weekly chart? Okay, I guess for the week, M2 Money stock went up 104 billion, and for the month, the Fed's balance sheets still increased 450 billion. I still believe that was into some of the bond markets, but to give you the overall assessment of what I see in the market, it looks like there still is a little bit of persistence and fear in the market. You do see that a little bit with bond prices, as well as the way the dollar and yields are moving relative to each other. I still just have my money into the precious metals, uh, some gold stocks, silver stocks. Oil is just ludicrously undervalued. I showed you that ratio of the S&P 500 to oil, okay? If I told you that you're buying oil at all-time low valuations, would you just buy it? If I told you it was the cheapest you would ever get these assets, would you just buy it? And if the answer is yes, then the time is literally right now. Like oil stocks has never been cheaper to technology. And even if the ratio just mean reverts, okay, if the ratio just mean reverts, you can make 40 times your investments. Every $1,000 you invest can turn into 40 times your money, okay? The time is now. So this is Xavier with Daley Paulk. I really appreciate you watching this video. Leave a thumbs up, leave a comment. If you have any questions, just type them in there and let's have a conversation. Have a good one.